Welcome to today's lesson about the SIE exam. In this lesson, we will be taking a deeper dive into some regulatory legislation. There's a lot of regulatory legislation out there, so it's going to take a little while, a couple lessons to really parse out all of it. And we've talked about some of it before. Some of it will probably be new to you. At the end, I'll give you a chance to go ahead and quiz yourself to make sure you are ready to move on to the next lesson. So let's go ahead and get started. So understanding these topics is essential for the Securities Industries Essentials exam. Today we'll explore the foundational laws and acts that govern the operations of securities markets in the United States, focusing on their history, implementation, and impact. So first, I'd like to dive in a little bit more into the Securities and Exchange Act of 1934. So the Securities and Exchange Act of 1934, or the SEA of 1934, was established primarily to govern securities transactions on the secondary market after they're issued, ensuring greater financial transparency and accuracy, all while preventing fraud. It creates the Securities and Exchange Commission, the SEC, which is a key regulatory authority in U.S. financial markets that is tasked with enforcing federal securities laws. The SEA of 1934 also requires all securities listed on exchanges and in the over-the-counter markets to be registered with the SEC. So before they can be offered, they have to be registered so that the SEC can oversee them. That's a really important thing to remember. This act was a direct response to the stock market crash of 1929. So if you know your history, that stock market crash was a catastrophic event, and it kicked off the Great Depression. And so in response to the Great Depression and all the turmoil that was going on in the United States and around the world, frankly, they created this Securities and Exchange Act so that there would be more regulation, so that things would hopefully go more smoothly in the future, and they could avert another crash like the one in 1929. They hoped to restore investor confidence through this act and maintain fair dealing in the markets so that things would run more smoothly in the future. So that's a really fundamental piece of legislation that you should be very familiar with. Another thing that's important about this act are the listing requirements that are set down in this act. So in order to be listed on a stock exchange, companies must meet specific criteria set forth by the SEA of 1934, along with requirements that are imposed by the exchange itself. These criteria include meeting minimum thresholds for total assets, earnings, share price, and number of shareholders. So there's all of these criteria that you have to meet before you can list. Companies must also adhere to rules regarding the disclosure of important financial information and periodic filing of various SEC forms like 10-Ks, which are annual reports that you have to file with the SEC, and 10-Qs, which are quarterly reports, where you have to tell them certain things about your finances so that you can make sure that you're still on strong financial footing. So this ensures that all potential investors have access to essential information to make informed investment decisions. So that's why all the reporting, because you have to have all of the information in order, and then you need to have that transparency there. The SEC is managed by 5 commissioners who are appointed by the President of the United States with advice and consent of the Senate. These commissioners hold the titles of chairman and commissioners, and they serve staggered 5-year terms. So it's staggered so they don't all get booted out at once. So it's not like a fresh batch of 5. They They're staggered so that there's always more experienced members on the commission. The roles of these commissioners include making rules regulating securities industry practices, overseeing the inspection of securities firms and private regulatory organizations, and coordinating U.S. securities regulations with federal, state, and even foreign authorities. The chairman acts as the administrative head of the SEC and represents the commission publicly. So if they're going to give a press conference or say something publicly, then that's the commissioner's job. All right, so that's all about the SEC of 1934. Now I'd like to move on to one called the Investment Advisors Act of 1940, so a little bit later. The Investment Advisors Act of 1940 was established to regulate advisors managing portfolios of securities, requiring them to register with the SEC and abide by regulations designed to protect investors. So remember, we talked a little bit about the Great Depression. So this act in the 1940s was rooted in the aftermath of the Great Depression. So that's still the backdrop against what we're seeing. And it addresses issues of fraud and conflicts of interest among advisors to ensure that they act in the best interests of their clients. So in other words, that they're acting as a fiduciary. It defines an investment advisor as anyone who, for compensation, engages in the business of advising others on securities investments. This act plays a crucial role in ensuring transparency and honesty in the relationship between investment advisors and their clients. So let's talk a little bit more about the historical context of this act. So the enactment of the Investment Advisors Act of 1940 was significantly influenced by the stock market crash of 1929 and the subsequent Great Depression, which highlighted numerous financial abuses and the need for greater regulation. Prior to this act, investment advisors operated without much oversight at all, which led to widespread abuses and the loss of public trust. The regulation was intended to restore confidence in the financial markets by requiring higher standards of behavior from those who were advising on investments. So before, there was a lot of fraud, misrepresentation going on. Yeah, so that's part of what led to the whole stock market crash in the Great Depression. Now, there are some exclusions from the Investment Advisors Act of 1940. Certain persons or entities are excluded from the regulations under this act. These exclusions include lawyers, accountants, teachers, and engineers who offer investment advice as part of their profession, but do not primarily act as investment advisors. So a lawyer might give you some advice, but that's not their main job. They're not an investment advisor, they're a lawyer. So in this case, they're not going to fall under this act. Additionally, any broker or dealer whose performance of such services is solely incidental to the conduct of their business as a broker or dealer, and who receives no special compensation for those services, is also excluded. So it's important to know the exceptions to the rule as well as the rule. My next thing I want to go over is the Securities Investor Protection Act of 1970, also known as the SIPA or SIPA. So the Securities Investor Protection Act of 1970 created the Securities Investor Protection Corporation, or SIPC, which serves to protect customers if their brokerage firm fails. This act provides a special insurance-like structure for customers, ensuring that they can recover their cash and securities that may be in jeopardy if the brokerage becomes insolvent or encounters other financial difficulties. The SIPC plays a critical role in maintaining investor confidence in capital markets by providing a safety net in cases of brokerage failure. So SIPC coverage extends to certain types of financial harm, including the replacement of missing stocks and other securities when a brokerage firm closes due to bankruptcy or other financial difficulties. However, it's also crucial to note that the SIPC does not cover investor losses caused by market decline or bad investment advice. So those just happen. For example, if a brokerage firm is closed and investors have stocks or bonds missing from their accounts, SIPC will work to return those securities. The coverage limits are up to $500,000 per customer, including a $250,000 limit for cash claims. All right, so now I'm going to ask you some questions. You can quiz yourself to see how well you understood the types of legislation that we talked about today. There are a few main ones. See if you understand. If you're doing well, then you can move on to the next part where we'll discuss a few others. But if not, just go ahead and review what we talked about today. Lots of good stuff here. All right, my first question is, why was the Securities and Exchange Act of 1934 enacted? All right, well, there are a few reasons for this. But basically, it was because of the stock market crash. That was a big deal in 1929 that sparked off the Great Depression. And part of the reason that that crash happened is because there were a lot of unscrupulous people who were taking advantage of others. And it was obvious that there needed to be a lot more regulation in the securities industry than there was. And so this act was partially in response to that. This is saying, oh, wow, things are not very good. And we don't want to have something like that happen again. So that's why the act was enacted in the first place. My next question is, what are two requirements for a company to be listed on a stock exchange according to the SIE of 1934? There are a few different things they have to do, but just name two of those. So to be listed on there, they have to meet these minimum thresholds for total assets, earnings, share price, number of shareholders, and they have to adhere to rules regarding the disclosure of important financial information. So what are the two different forms that they are required to file with the SEC if you want to be listed on a stock exchange? There are two different forms that you need to fill out on a regular basis. What are they? All right, so we have the two forms. They got the K10, the 10Ks, which are the annual reports that you have to give to the SEC. And then we have the 10Qs, which are the quarterly reports that you have to give to the SEC. So this must make sure that they have all the information so everybody can be as transparent as possible. My next question is, what are the roles of the 5 commissioners who are assigned to the SEC that oversee the SEC? So these 5 commissioners, they're called the chairman, one of them, and then the other 4 just regular commissioners. And they make rules regulating securities industry practices. They oversee the inspection of securities firms and private regulatory organizations, and they coordinate U.S. securities regulation with federal, state, and foreign authorities. So it's a really important job. How are these 5 commissioners selected, and how long do they serve? So they are selected by the President of the United States, and they serve staggered 5-year terms, so they're not all leaving at once. All right, my next question is, how does the Investment Advisors Act of 1940 define an investment advisor? So who falls under that category? All right, so this act defines an investment advisor as anyone who, for compensation, so they are paid, engages in the business of advising others on securities investments. So they have to be paid. That has to be their job. Name 2 types of professionals who are excluded from the regulations under the Investment Advisors Act of 1940. So there are a lot of these, but one really common example is a lawyer. They might give this advice, but that's not their primary bread and butter. That's not what they're supposed to do primarily. Also a teacher or somebody giving advice, let's say like a professor or whatever, doesn't have to fall under these particular regulations. It's just people who are doing it for compensation. All right, my next question is, what historical event prompted the creation of the Investment Advisors Act of 1940? All right, so we talked about this a few times. This was, of course, the stock market crash of 1929 and the subsequent Great Depression. The part of the problem that this is trying to fix is that there were a lot of people out there giving bad advice to people who were not regulated, and so they just were allowed to give people really bad advice. And nobody was calling them out for it. And that's part of why the stock market crash happened in the first place, is people were making bad decisions based on faulty advice. So, yeah, this law and other legislation, these were efforts in order to correct that and prevent that from happening in the future. My next question is, what organization does the Securities Investor Protection Act of 1970 establish? So the SIPA establishes the SIPC, the Security Investor Protection Corporation. And so what does the SIPC do? It's meant as a sort of safety net, but what is it a safety net from? Who does it help? So in this case, it helps protect customers if their brokerage firm fails. It's kind of like the FDIC, where that protects customers if their bank fails. This helps you if a brokerage fails and can provide you some remuneration if that happens, up to a certain limit. Of course, just like the FDIC, there are limits to what can be insured. And what types of losses does SIPC coverage not protect against? So it does protect if the brokerage goes bankrupt, insolvent, has big financial problems, but it does not protect against losses that happen just because of market decline or bad investment advice. Those things are not covered. So then what are the limits of coverage per customer. So in this case, it's $500,000 per customer, and there's a $250,000 limit for cash claims. That's an important distinction to make. What is the primary purpose of the Federal Reserve's monetary policy? So the primary purpose is to manage the economy's money supply and to tweak interest rates up or down to achieve economic goals such as maximum employment, stable prices, low inflation, and moderate long-term interest rates. So that's what the Federal Reserve uses monetary policy for. My next question is, how does FINRA contribute to market integrity? So FINRA contributes by regulating broker-dealers, enforcing trading rules, licensing agents, arbitrating disputes, and promoting market transparency. So those are all things. So if you got a few of those, great. So FINRA does a lot of different things, wears lots of hats. That's why it's so important. My next question is, what type of protection does the FDIC provide its customers? So the FDIC insures deposits made in banks up to $250,000 per depositor per insured bank for each account ownership category. So these protect deposits in case of a bank failure. So if the bank were to go under, these people would not lose their money. Unfortunately, if it's more than $250,000, unfortunately, they would be out that money. My next question is, describe the role of the MSRB in the municipal securities market. What did they do? So the MSRB regulates the municipal securities market in a few different ways. They set rules for security firms and banks that are involved in underwriting, trading and selling municipal bonds, and they do this to ensure fairness and transparency. My next question is, why were blue sky laws implemented? So blue sky laws were implemented to protect investors from fraudulent sales practices and security schemes by requiring the registration of security offerings and full disclosure of financial details. So help people from being defrauded. Definitely don't want that. My next question is, what does the Securities Act of 1933 require from issuers of securities? So it requires issuers to provide accurate and complete information about themselves and the securities that they offer. And remember when I talked about a prospectus? That has all that information in it that helps prevent fraud and deceit. So how does the National Security Markets Improvement Act of 1996 affect state securities regulators? So remember, this is the one that has to do with both state and federal agencies. So how does this act work? So it preempts the state from regulating certain aspects of securities and issuers that fall under federal oversight. And this is aiming to streamline securities regulation and reduce redundancy. So if one level is taking care of it, the other level doesn't have to. So it just makes things more efficient. The next question is, what is the importance of the Federal Reserve Act of 1913? So the act itself established the Federal Reserve System as the central bank in the United States. Okay, my next question is, how is the Federal Reserve different from the Department of the Treasury? So what does the Department of the Treasury do that the Federal Reserve does not? So the Treasury manages the government's revenue and money by handling federal finances, issuing currency, so that's not something the Federal Reserve does, they just hold the currency, managing government accounts and public debt, and just advising on fiscal policy. It's the Federal Reserve actually makes the fiscal policy and carries that out, but the Department of the Treasury just advises. So they're similar. They've got similar goals and a lot of similar things that they do, but a little different. My next question is, how does the Federal Reserve's decision to change interest rates affect the economy? We talked about a few different ways that this is the case. So changes in interest rates affect the borrowing costs for individuals and businesses. So when they want to borrow money for investment or buying a home or starting a business or whatever they want to do with the money. All right, how did you do? If you are ready to move on to the next lesson, go ahead. If not, you might want to review what we talked about today before moving on. And that's all for our lesson for today. Thank you very much for listening.